Hello everyone, welcome back to A Beginner's Guide to Investing. It is once again your host, Ruhan Gupta. This is episode 3, and in this episode, I'll explain how you can invest in bonds. We have another guest today, Mr. Sanjay Aggarwal, who will explain his viewpoint on bonds from the perspective of retail investors and give us a couple of pointers. Just to recap the last episode, I explained the basics of bonds and mutual funds to ensure you would comprehend this episode and in general to certify you have knowledge that is nowadays deemed compulsory. Nevertheless, in today's episode, I'll inculcate and talk about how you can net gains with bonds. In the next episodes, I'll teach you how to evaluate shares, mutual funds, derivative trading, currency trading, along with a multitude of other concepts. Also, I'll explain selling and buying bonds on the secondary market. I do not want to incorporate it into this episode as it itself is a complicated keynote that requires a completely separate episode. Likewise with mutual funds and bond funds. With each of these financial assets, I'll provide you with a couple of guidelines you should follow while investing, and I'll also explain the reasoning behind these guidelines. Let us start off now. First of all, I will address a query I see come up quite frequently. Why would you want to invest your hard-earned money into bonds? Well, there are multifarious reasons and I'll explain each one individually. The first reason as to why you'd want to invest in bonds is diversification. Diversification can help reduce your portfolio's risk so that one asset or asset class's performance doesn't affect your entire portfolio and consequently your earnings. Secondly, bonds provide a stable and predictable source of income. For instance, in the stock market, I do not know for certain whether the price of the share I've acquired will climb or decline. Nevertheless, with bonds, I know I will get a certain amount of money over a particular duration of time. Thirdly, bonds help in preserving capital. When is this helpful? Well, it is helpful when we discuss portfolio management. For example, let's say in the next 15 years, you want to reach a certain investing goal. Let's say this is money for your child's education. Around the 13th to 14th year, ideally, you should be nearing that goal. Thus, you'd want to preserve your capital instead of going for more risky investments such as equity. And therefore, you would reallocate your capital to bonds/debt. Finally, there are tax-free bonds. Anything tax-free is always going to be an advantage. Moving on, let us discern when one should invest in bonds. You should invest in bonds after looking at the rally of the market over the past year and a half and gauge whether there will be any profit booking. Secondly, you should invest in bonds when you're close to attaining a certain investing goal you have set for yourself. This is because at those instances, you would want to preserve your capital and not run the risk of losing it in equity. This relates to the previous example I'd given concerning capital preservation and, of course, your goals. Finally, when you wish to permute your risk profile, you should invest in bonds. So let's say I want to bear less risk because I just got married, for instance, or I'm reaching old age soon. Let's just say it's a very arbitrary example. Let's just say that's the reason why you want to change your risk profile. So you're going to reallocate your investments in equity to debt. That is how you're going to permute your risk profile. Now that I've explained to you why you should invest in bonds and when should you invest in bonds, let's move on to the checklist which delineates each step of the investment process in bonds. These preceding points, which is the fundamental points you should keep in mind whenever you question why are you making a certain investment. Now, the first thing you must check when you're analyzing a bond is the coupon rate, yield, and yield to maturity. I've already explained coupon rates in my previous episode. However, I have not defined what yield and yield to maturity are. Yield is quite intuitive, actually. A bond's yield is the amount that it pays each year in interest as a percentage of its current price. It is calculated by dividing the coupon amount by the price of the bond. The higher the yield, the better. For example, if a bond is sold at $100 and pays $5 per year, its yield is $5 because 5 divided by 100 times 100 is going to be 5%. It's just the return you're getting. So yield is basically the return you're getting. When the price of a bond goes up, its yield goes down. If that same bond is now being sold for $105, its yield would be 4.76% because 5 divided by 105 is 4.76. Remember, the return you're getting is 5 dollars. We're not saying that the yield is 5%. We're not saying the return is 5%. We're saying the return is $5. And the same applies the other way around. If the price of that bond dropped to $95, its yield would go up to 5.26% because $5 divided, which is your return, divided by $95, which is your principal amount, is going to give you 5.26%. Nonetheless, be wary with high yield bonds as they present the greatest risk. For example, the Argentinian government's bond current yield is around 44%. And guess what? It's defaulted on its debt 8 times. Now, to understand yield to maturity, let us start by looking at a simple example. Imagine we have a bond that has $1,000 face value with the 5% coupon that is paid annually for 5 years. If you were to hold this bond until maturity, we would receive $250 because, 5% of 100 times 5 is going to give us $250. Using the yield to maturity formula, we would have ascertained that we will net a 5% profit from our bond each year. So once again, 5% of 1,000 times 5. So we know 5% of 1,000 is 50. 50 times 5, because we'll get that each year. We're going to receive $250. Nevertheless, this formula, yield to maturity, is generally used with discount or premium bonds. So the yield to maturity is always going to be the same with with the coupon rate if you have bought the bond at face value. Assume we had the same bond, but we bought it at $900, which is not face value. These are what we call discount bonds, and the exact opposite of this is called a premium bond. So in this case, we're still going to get paid $50 each year for 5 years. This is because the coupon is based on the face value of the bond and not on the trading value. Remember, trading value is only associated with the secondary market. Once you reach maturity, assuming the company has not gone bankrupt, you will get $1,000, which is the face value, even if you did not pay for that, because at the date of maturity, you're going to receive the face value plus your interest. In effect, this means that you have made a profit of $100 because you paid $900 but got paid back $1,000 in addition to all those interest payments. In total, you have received $1,250, but you only paid $900, netting you a profit of $350. You have made more money, and therefore your profit per year, which is also called the yield to maturity, is going to be greater than 5% per year. The yield to maturity tells the exact number. However, the calculations are quite complex. The formula is very complex, and thus it is best if you understand how to calculate yield to maturity by yourself. I'll provide a couple of helpful links if I'm able to on this platform to aid you. But it's really easy just to find it out online. Thus, the higher the yield to maturity, the greater your returns. The second thing you must look at when evaluating bonds is the minimum amount of investment required. There could be bonds ranging from $1,000 to $50,000. You must assess your investment appetite and choose accordingly. Thirdly, refer to the rating of the bond. There are multi-phase rating agencies that rate bonds. Please consult these agencies prior to investing. Bonds assigned ratings above a certain threshold are considered investment grade, while bonds rated below the threshold are known as sub-investment grade or high-yield bonds. Any bond that is rated above BBB is considered as investment grade. Which bond is suitable for you? Well, depending on your risk appetite, when making your investment decision, you may choose to invest in either an investment-grade bond or a high-yield bond. An investment-grade bond is a more secure investment and should give you a stable source of investment income. A high-yield bond pays a relatively high return but carries with it a risk of default and will therefore require closer monitoring. However, in all cases, the repayment of bonds is always subject to the creditworthiness of the particular issuer. It is generally recommended one only invests in investment-grade bonds. Fourthly, you must look at the tenure and IP frequency of the bond. IP frequency is the investment payment frequency. So we were talking about this earlier. Semi-annually, you'll get your interest. Annually, you'll get your interest. Quarterly, monthly. They're all examples of IP frequencies. Tenure is just the time it takes for the bond to mature. Additionally, one needs to also see if the interest payments are tax-free or not, and if the bond is secured. Secured bonds are backed by specific collateral, which reduces the risk for investors. Unsecured bonds are backed by the creditworthiness of the issuer. I would suggest for you to go to secured bonds instead of unsecured bonds, because at least there's some consequence to these companies that issue secured bonds, so therefore they're more likely to pay back on the bond. All these steps will ensure you invest in a bond that meets your investment and risk appetite. Moving forward, let's talk about the risks you could face when holding individual bonds till their maturity. Notice I've not said that I'll explain the risks that are associated with buying and selling bonds. I again said that I want to do justice to that avenue of investment by creating a separate episode for it, which is going to be based on selling bonds on the secondary market. Namely, there are four forms of risk you can face using bonds. Credit or default risk. This is the risk that the bond issuer or borrower is unable to meet the coupon or principal payments on any outstanding bonds or debt, not just the bonds you may be holding, when they fall due, for example, due to bankruptcy or insolvency, and go into default. Stay away from bonds that are not investment grade if you do not want to take the risk of possible default. Let's move on to the second risk, which is event risk. Events such as leverage buyouts, mergers, or regulatory changes may adversely affect both the bond issuer's ability to make payments on the bond and the price of the bond. This is much harder to predict. Sovereign risk. Payment of the bond may be affected by the political and economic events in the country of the issuer of the bond. For example, the issuer may be forced to make payments in the local currency of the issuer's country instead of the regional currency of the bond. Do not invest in corporations that are based in politically unstable and volatile nations. And finally, we have currency risk. Currency risk is the possibility of losing money due to unfavorable moves in exchange rates. Investors holding bonds issued abroad and denominated in foreign currency face the additional risk of currency changes to their overall return. Currency risk can be mitigated through hedging strategies or by investing in foreign bonds that are denominated in your home currency. An example of this would be euro bonds. Currency risk arises from the currency of denomination of the bond and the location of the investor, rather than the domicile of the issuer. A US investor who holds a yen-denominated bond issued by Toyota Motor is obviously exposed to currency risk. But what if the investor also holds a Canadian dollar denominated bond issued by IBM in the US? Currency risk exists in this case as well, even though IBM is a domestic company. However, if a US investor holds a so-called Yankee bond or a euro dollar bond issued by Toyota Motor, exchange risk does not exist despite the issuer being a foreign entity. A slide in the currency in which your bond is denominated will lower total returns. Conversely, an appreciation in the currency will further boost returns from holding the bond, the icing on the cake, so to speak. Consider a US investor who purchased 10,000 euros face value of a 1-year bond with a 3% annual coupon and trading at par. The euro was flying high at the time, with an exchange rate versus the US dollar of 1.45. This means that 1 euro equal to $1.45. As a result, the investor paid $14,500 for the euro-denominated bond. Unfortunately, by the time the bond matured a year later, the euro had fallen to 1.25 against the US dollar. The investor, therefore, received only $12,500 upon converting the maturity proceeds of the euro-denominated bond. In this case, the currency fluctuation resulted in a $2,000 foreign exchange loss. Many international fund managers hedge currency risk rather than take the chance of returns being decimated by adverse currency fluctuations. The most common methods employed to hedge currency risk are currency forwards and futures, or currency options. However, hedging itself carries a degree of risk since the cost is attached to it. As the cost of hedging currency risk is largely based on interest rate differentials, it can offset a substantial part of the higher interest rate offered by the foreign currency bond, and thereby undermining the rationale for investing in such a bond in the first place. Alright, that concludes our section on the risks associated with investing in bond. Let's now speak to our guest, Mr. Sanjay Aggarwal, and ask him certain things we should avoid when investing in bonds. How are you doing, Mr. Aggarwal?
I'm doing well. How about yourself?
I'm doing great. Now, I wanted to ask you something that I really think would help our viewers. What are the common mistakes you have seen yourself or others make when investing in bonds?
Excellent question. There are three common mistakes which I see. Firstly, always note the claim status. Certain bondholders receive priority when a company defaults. These are senior notes. It is of paramount importance, what type of bond you hold, as that permutes your risk profile. For your information, bondholders are given priority over shareholders when a company defaults. Consult your bond certificate or brokerage to check the kind of bond you hold. It is best if you hold a senior note bond. Secondly, do not just assume the company is good. Check its history. Do your due diligence in discerning whether there is a possibility the company could default. The goal of this homework is to gain some level of comfort that the bond you are holding isn't some type of experiment. In other words, check that the company has paid in debts in the past, and based upon its past and expected future earnings is likely to do so in the future. One can do this by consulting the corporation financial reports. Thirdly, be prudent when it comes to inflation. Pay attention to reports regarding inflation trends, as inflation is a bond's worst enemy. Inflation can eat away a fixed income investor's future purchasing power quite easily. Typically, bonds are fixed rate investments. If inflation is increasing, or say prices rising, the return on bond is reduced in real terms, meaning adjusted for inflation. For example, if a bond pays a 4% yield and inflation is 3%, the bond real rate of return is 1%. What can an investor do then? Well, either you could purchase high yield bonds, purchase bonds in other nations that have less imminent inflation, or purchase real return bonds. Each of these circumventions have their own associated issues. So, do your due diligence in ascertaining which options is appropriate for yourself.
These are some very good points indeed. Thank you, Mr. Aggarwal, for your time.
No worries.
And that was it. That was everything you needed to know when investing in bonds. In the next episode, we will be discussing how you can invest in mutual funds, so do stick around for that. Thank you for listening to this podcast. Please leave any suggestions/improvements in the comments. Goodbye, and see you in the next episode.